Welcome to the Paper Trail, where we follow the journey, my journey, through the world of a CEO of a mortgage note fund. I'm Chris Seveney, and after years of buying, managing, and selling notes with Seveney Investments, I'm here to share the real stories behind the deals. What went right, what went wrong, and what I wish I knew earlier. From non-performing loans to seller financing to private lending, this show is about more than strategies, about growing your business, learning to follow the paper trail, and doing the due diligence that separates the pros from the rest. Now, let's hit the trail running. Welcome back to another episode of the Paper Trail Podcast. I am your host, Chris Seveney, CEO and founder of Seveney Investments. Today, I want to talk about where we are in the mortgage note cycle. And having been in this business for over 10 years, we have seen different market cycles. We have seen lots of crazy stuff that has happened. And one of the things that, as an operator, we must always be focused on is adjusting and staying focused on what it is we do and how we do it, which I believe we're very strict on in regard to this purpose-built platform that really focuses on borrower engagement, legal expertise, and asset level evaluation and exits, and being able to take this and scale this nationwide. But over the last several months, I've been thinking, and as we put our 2026 business plan into play, we started people asking me, Chris, where are we in the cycle? What should we be looking for? What are some of the red flags that you are seeing? That's what I want to talk about today. Again, everything today is my opinion. I'm not a guru. I'm not selling any type of product or training that would impact or provide anything to anybody. I'm just a guy sitting in his chair on a Sunday morning telling you my thoughts. So where are we in the cycle? A few things I want to talk about in the cycle we're in. First, home prices are no longer doing the work. And if you've ever listened to me, I've made comments in the past that somebody could have been in a foreign country, in a coma, anywhere over the last 5 years, and home price appreciation saved you from every single mistake you would have made and allowed you to make money. No longer the case. You need to be an asset manager, and that is where you're going to be making your money. Second, everyone's nervous that the economy is going to collapse or housing is going to collapse. The distress is concentrated. It's not widespread. You can look at charts and maps out there, what's going on in Florida, Texas, and some of these other markets, but it is concentrated. It is not widespread. Another is liquidity is selective. It's not absent, it hasn't gone away, but it's being very selective. On investment properties, you're seeing lending guidelines tighten significantly because people are trying to refinance their way out of problems. On the homeowner front, again, being selective on that side of things, seeing appraisals be reviewed and come back. They're being much more peculiar in regards to those and evaluations. And lastly, in the non-performing note space, time is now a significant risk variable. And we'll talk a little bit more about that in a bit. All of this boils down to the NPL market and how are they behaving? What is going on? What are the borrower behaviors? What are we seeing for collateral and notes? What is required to properly manage your asset? And how is the pricing? How is the outcomes? So first, let's talk about borrowers. Borrower behavior shifts is occurring because their options are narrowing. Previously, borrowers getting behind, they could easily sell the property because it was appreciating. They were allowed to do modifications or workouts. Those have gotten tighter and those standards have tightened, so there's less options for borrowers because of that liquidity. So where are you seeing borrowers now do? The lenders aren't willing to play ball with them. They're going to file bankruptcy. Bankruptcy, which is, I love buying loans already in bankruptcy. Not a fan of when your borrower files bankruptcy because time, which we'll talk about later. We're seeing fewer clean early resolutions, meaning buy a loan, that workout of being able to do something within the first 90 days, it's taking longer. It's not clean in regards to the borrower agreeing to certain things, because previously they had more options, which have less options now, and it's taking longer to them to figure out what those options are, because those options are more painful than they were in the past. Hands-on oversight. Anybody getting into the NPL space, you need to have hands-on oversight. Yes, we have servicers. Servicers are like your property manager and manage the day-to-day activities, but you need, when they are in default, to really take the bull by the horns and stay on top and manage those assets. If you can't, find somebody that can for you. But if you're just going to let them sit out there and rely on your servicer, that's going to be problematic. Now, for us, we buy a lot of loans from larger institutions that outsource their third-party management. And for us, we love buying loans from companies that use third-party management. I'm not going to get into the reasons why. We just thoroughly enjoy it. Lastly, some of the pricing discipline has created some flexibility. And what I mean by that is we price things in a specific manner. And previously, you were just told no because sellers were banking on property appreciation, which wouldn't devalue the note. Today, time is their enemy. So staying disciplined, you see sellers coming back to you after the fact, accepting those numbers. We recently put in a bid that started out at about $4 million of loans, and we get the collateral and we get valuations and so forth, and 4 million turned into about 2 million. That's how big of a cut they had to take, or we had to take, off of those numbers because of the significant issues we found in the collateral and valuations in servicing notes. They came back and laughed at us, which I figured they would. But then a week passed and then asked, well, would you consider this? Would you consider that? Because they know they're not going to sell those loans. Again, because of the size, most people that they're selling to probably also outsource that management. Where we in-house manage, we can get a little bit more creative and pay more attention to these loans, but we're not going to do them a favor and pay a premium for that service. Now, I've been talking about time a little bit, and I would say today, time is your greatest risk factor. Why do I say that? If you're getting involved in judicial states, which we do, and we're kind of shifting a little bit away from some of these, it's because those timelines are stretching under the volume that they're seeing. Now, if you look at reports that come out from some of these magazines that show 300, 400, 500 days to foreclose, we're never hitting those numbers because we're typically a third or half those numbers based on how we manage. But we are seeing courts require additional mediation. Service to hand the person a lawsuit is taking extra time. So remember, foreclosure is a process. It is not a date on something going to happen. It's a process that takes time. And because time is now being stretched a little bit, carrying costs are quietly compounding. And previously, we talked about valuations and where are the values of the properties and how is that working out. One of the things that we do is we score every loan. I call it, is it helping or hurting us? If where time continues and we're getting close to or above loan to value, not investment value, loan to value, it's hurting us because we can't collect those costs. For example, we have another loan where the balance of the loan is about $800,000. It's collecting interest, but the property's worth $2 million. So if this one drags on for an extra 6 months, we're collecting interest on this, and because we bought it at a discount, the cost or the payoff of that loan is carried or is above, our cost of capital. So in this instance, it's not hurting us. But understand today, time is that greatest risk. So how do you mitigate that time factor? I've already told you. Asset management is going to be your greatest differentiator. You must manage the assets because many of us are yield focused and internal rates of return. It is highly sensitive to time. But you have to look at it from the lens of, and too many people just focus on IRR and realize, oh, well, your reinvestment rate should be the same as this. And now chasing yield and chasing IRR, go back to what I said a few minutes ago. You need to evaluate your portfolio on, is time, these assets friendly? Are they a foe? And then you need to focus on the ones where they're a foe and really pay much more attention to those, because those are the ones that can have an impact on your portfolio. So that's some of the mistakes I see. What are some of the other common mistakes that I see people making? People bid as foreclosure is the only strategy. And they think, especially in these non-judicial states, oh, I'm just going to foreclose and be out of this deal in 4 to 6 months. And the borrower slaps a draw 4 card, which is in Uno, which in no sense is the bankruptcy card, because they will file bankruptcy. And ignoring bankruptcy as a management tool by them is going to cost you. Tied to that is, poor borrower exit decisions, meaning you can guide the borrower sometimes and educate them on some of the decisions that they need to make or want to make. Here is a perfect example. We have a borrower. It's not their owner-occupied home. It's a rental that we gave them the option of give us a deed in lieu on the property, and we won't go after any deficiency. We'll just call it even. Or you can attempt to sell the property, but recognize that interest is accruing. And if you go to sell it and it's a short sale, we are going to require you to pay the delta or the difference. And we are being very blunt with you that here are the options. And if you sell it and all of a sudden you realize that you negotiate and then you're $15,000 short from the short sale, we don't care. We are telling you now, we are not going to accept it. Be very definitive in educating your borrowers on what their options are, what their outcomes are. Lastly, this is one everybody makes. Do you hold assets too long after your value is maximized? Goes back to, is it hurting you or helping you? And if you sell it today, do you make money? Do you not make money? But is it better than taking the risk to let it drag on? And then how will that impact you? So that's the one I think probably is one, as an asset management side, that is the one I see the most. On the acquisition side, it's people only looking at that one exit strategy and not understanding that there are significant and many other exit strategies. So as a disciplined operator, what are we doing? How are we adjusting? We're underwriting longer timelines. So we've adjusted our models to account for how long, the reality of how long it's taking. I don't care what USFN says how long it takes. I don't care what any of these other sources say how long it's taking. We take our historical data, use it, analyze it, and measure it, understand what it's taking. We're also evaluating our attorneys to see, is one attorney better than the other in this state or that state, because that can have a significant impact. We always preserve multiple exit paths. You can't corner yourself into one exit scenario. Always give yourself options. Another, and this was one over the last 6 months and ties into some fraud we're seeing. There's a lender out of Beverly Hills, California, for example, that is being sued by Turac, where they were selling multiple loans. They were also pretending to be the servicer, because they, I think, originated the loans and stepping in to say they're still a servicer when they're not, and collecting payoffs and using that money to fund other investments and other things, allegedly. But there's a lot of fraud going on and a lot of people doing really shady shit. So one of the things that we have started doing is we are securing the collateral and documentation upfront before we wire funds. Previously, we would get the digital copies and get scanned copies of the assignment and launch and wire the funds, and then that document would be released to us a few weeks after. But what we have found is it was taking too long. Some documentation was taking 60 or 90 days to get, which would impact how long we couldn't send a demand or foreclose. So we've had one seller, wow, that was a real Boston accent there, who was just awful. They didn't know how to do any of this. And we closed 3 loans with them. And then when we went to close the other batch with them, we told them, hey, look, the guy needed the money. And we're like, well, you're not getting it until you forward over the collateral. Now we use what's called the Bailey, which is a third-party company that holds the collateral. And then they release it once funds are received, but they're the ones kind of holding it to make sure everything is there. Definitely something, again, a big shift internally for us that we've started focused on. That, and again, as you scale, it's definitely something you need to do. And lastly, prioritize control over compression, and focus on what you can control is very important and something that you have to stay disciplined in. Lastly, as you look towards your business and what and how you do things, what are some of the things you need to reevaluate? You need to reevaluate how assets are being valued. Because we've seen BPOs, we order 2, we've seen some come back, same property come back at 310 and 400,000. That's a big difference. How are you evaluating them? Just don't look at the number, do your own research, which is something we have always done. Second, where your timeline's coming from. As I mentioned, I don't trust third-party sources. Talk to your attorney that you're using. What is it taking? That is your best reference point if you are newer to the space. If you've been around for many years and have done significant work on defaults, then you have better timelines. Now for us, yes, we've done hundreds and hundreds of deals. Our foreclosure rates are actually very low. Now we start foreclosure, but rarely do we ever see it through fruition. So it's always good to discuss and understand. Third is, how are your services and vendors being managed? What is going on? How are you managing them? Is it working? Because have those teams adapted post-COVID? Attorneys we use pre-COVID, we won't use now post-COVID, and vice versa, because they've had change of staff. They just don't fit our business model. And that's important. Just because somebody is great a month ago doesn't mean they're going to be great for you 2 months from now. Think about you and a family buying your first house. If it's just you by yourself or you and a significant other, and next thing you know, you have 3 children, look, you might outgrow that property and you need to make a change. There's nothing wrong with it. It suited your benefits during that time. But as you grow, scale, or change, you need to adjust. Lastly, I want to finish with plenty of opportunity in the space. The opportunity remains. The key is discipline is going to win. And this phase will feel very uncomfortable for people because it is not easy. It is going to take a lot of work, a lot of thought process, a lot of game planning and scheming. But non-performing notes still work, are still profitable when they are managed well. But that discipline matters. It's going to be a matter more than creativity. Must maintain discipline. And lastly, follow your rules. You only buy certain types of assets, follow that. You only do X, Y, or Z, follow it. Place I see people get in the most trouble is they don't follow their rules, or they'll break the rule for this asset, that asset, or go doing something that isn't within their specialty. And then they think they can do it because the thing up here, your ego, gets to you. Don't let your ego get to you. Stick to your rules. Now, you can always adjust, and as you grow, modify and fine-tune them. but there are certain beliefs and structure of a company that you must follow. Well, I'm going to wrap up. Hope you enjoyed this episode of the Paper Trail podcast. I am Chris Seveney with Seveney Investments. Thank you all, and I will catch you on the next one. Thanks for joining me on this episode of The Paper Trail. I hope today's insights help you sharpen your note investing strategies. If you found value in this conversation, subscribe, leave a review, and share it with fellow investors. I'm Chris Seveney, reminding you to keep doing the work, trust the process, and always follow the paper trail. Until next time.